All right, we are live. Welcome everyone to the Mr. Rento Home Show. My name is Dominic Danino, aka Mr. Rento Homes, and today we're gonna dive a little deeper into assumable loans and how you, or if you're an agent, potentially you can get your clients to get into a home with rates as low as 3%. Right, with the market being where it is, conventional is around 7%, and FHA and VA in the mid sixes. If you could get yourself into a home or help your clients get into a home at 3% or 3.5% or 4%, I mean, anything less than what the current market is, it's an advantage to them, right? Because they're going to have a lower monthly payment, and it's probably going to be easier to qualify because the ratios won't be impacted because you have a lower payment. All right, so I am joined as always by my friend James Brown, real estate investor, real estate agent in Colorado. So welcome back, James. This is a hot topic we've been talking about. How you doing, brother?
Yes, it is. Let's dive in.
Yeah. All right. So we're gonna do a little screen sharing today, but before we start it there, just kind of talk about assumable loans and what the heck are they, right? So what are assumable loans? You want to take a shot at this? You want to kind of explain what you know?
Yeah, basically there's not all loans are assumable. FHA and VA loans are assumable. So the advantage is that a buyer can come in and assume a low interest rate loan that's existing. Most people have low interest rate loans, have refied into them if they've had the loan a long time. And boy, it can make a huge difference between being able to afford the home you want, having say a 3 or 4 or 5% loan versus, like you were saying, mid 6s to 7s right now. So, and with the way things are heading, doesn't look like we're going to ever see 3% again. Don't hold your breath, I guess, is the message. It'd be nice as a buyer if we could. So that's why we're talking about this.
Yeah, great point, right? So what's the reality of what's happening today, and if things are going to shift based on everything that's been talked about? Not likely, not in 2025 anyways, right? And maybe for longer. Right, so we had a situation where the Fed reduced the overnight rate or the Fed funds rate by 1%, yet the 10-year Treasury, which is what dictates mortgage rates, went the other way, right? Yeah. And that one tends to be based more on expectations of the economy, expectations on inflation, and things of that nature, rather than, hey, it's a 1-for-1 adjustment, because the purpose of those are two different things. So great explanation on assumable loan, right? So not every loan is assumable. There's specific loans. Typically, VA, FHA, and USDA are assumable. And so what does assumable really mean, right? So assumable is somebody qualifies to take over that payment, right? And that's done through a servicer. So it isn't just, hey, I raised my hand. Hey, can I just take it over without having to do anything? No, it's you have to go through the process of qualifying, just like if you were going to get a new loan. But what's happening here is the servicer that owns the note and services the loan has authority by HUD and VA and USDA to let somebody take over that debt, right? Take over that note at that rate that it was issued when it was originally originated, right?
Yep.
Okay, so great. So what do we do with that, right? I mean, so that's fantastic. You get to take over one, right? But for that purpose, you have to qualify. So you also have to bring credit, income, right, and a down payment. So it's fantastic that you're getting a lower than market rate. However, the balance doesn't start where it began when the loan was originated, right? You get to take over the balance. It doesn't start back up again. And so that's generally where people get stuck. Basically, the gap between what the balance is to what the seller is selling the property for, right? So just in round numbers, we're going to get into some of that, right? So, but basically is if the house is on sale for $1 million and the balance is 500,000, then the loan doesn't go back up to $1 million, right? It remains at 500,000. That's what you take over, and you have to come up with that difference, right? So you either have to have the money or borrow the money, and not all lenders, right? If you go to your credit union, well, maybe depends on the credit union. So you could theoretically borrow that difference, right? So FHA, VA will let you come in with gap funding, right? Obviously, when they qualify you, they're going to take that into account too, because you're going to have a second payment, right? Yep. But there's a point between that gap that it makes sense to go ahead and bring in a second mortgage or a purchase money second, as is known in the industry, a home equity loan. Basically, you're borrowing that difference. However, the home equity lenders aren't going to finance 100%. They're going to finance a portion of that. So you still are going to need a down payment, but they'll finance a portion of that, right? So typically, you still have to come up with either 10% of the $1 million, and then they'll finance the difference. So in our example, $1 million house that has a balance of 500,000, there's a $500,000 gap that you would have to come up with. Well, the home equity lender won't lend you the 500,000. They're going to say, hey, you got to come up with 10% of the purchase price. So 10% of that $1 million is 100,000, and we'll lend the difference. In this instance, it would be $400,000 second.
Yep.
Right? And then the assumer or the assumption department or the servicer that's qualifying you is going to ask you, is like, okay, so the purchase price, because you're going to provide a contract, the purchase price is $1 million. And this balance is 500,000. Where's the difference coming from? So you're gonna have to provide that you have the money in your bank account, right? So proof of funds, or you're gonna tell them, hey, I'm borrowing the other portion, or I'm borrowing the 400,000 from Joe Schmo lender, right, or Joe Schmo bank, and they're gonna say, okay, send us that paperwork, right? We want the approval, we want the information on that. Who do we contact over there to make sure that you're gonna have the money? That way, when the loan closes, so it'll be a traditional closing. So the assumption will come in, but the money from the home equity lender has to go into a title company. So that way it closes. And then obviously the seller gets that equity as part of the transaction, right? So it's basically two loans coming in at once, but one's already been in place and one is a new one, right? So that's the process of that. So yes, you can take over a cheap rate, but in the majority of the times, you're going to have to come up with money. You're not going to get financed 100%, not even 3.5%, right? If you were trying to do an FHA loan, if you took over an FHA loan that has that kind of gap, FHA doesn't start the balance up at the higher amount anymore, right? You just take over the existing, right? So there's a gap there, even though FHA allows you to come in with 3.5% on a newly issued loan, not on when you take over, right? That's the simple method. Yep. So there's that instance, and that's usually where people get stuck, right? So that's the bad of it, right? You got to come up with that difference, or know how to come up with that. So as you and I have discussed, right? So me as a lender, I have a couple of options of lenders that actually will lend on that gap, right, up to a certain portion. Obviously, you have to have credit, and you got to have verifiable income, and you will have to come up with some money down. Typically, it's going to be 10%. I do have a lender that will go as low as 5% if you really have good credit, right? And in combination, both payments is enough if your income is enough to service both payments, right? Just like on a traditional loan, right? So there is a point where it makes sense to do a combination loan, or Or it may be better where you just get one whole new loan and just have one payment, right? But based on where rates are today, you have to understand where that point is, right? So I have the tools. We have the tools to be able to kind of walk through that and see, does it make sense to do this or not do this, right? So basically, it's called a blended rate calculator, where it combines both balances at different rates, right? And the reason being is because the lender that's giving you the home equity loan, the second loan to come up with that gap, isn't going to give you the same rate that's on the existing mortgage that you're taking over, right? They're going to give you market rates, right? Does that make sense? So typically on home equity loans, market rates are going to be higher than traditional mortgage. So let's just take an example. Let's say 10%, right? So if you combine the 400,000 at 10% with the existing 500 at, let's say, 3%, what is that blended rate in combination? And then whatever that number comes up, is it better than the market rate where you can just go ahead and get one whole complete loan all at once? Anything else you want to add, or kind of questions or stuff that agents should be thinking about and clients should be thinking about, right? Now, you as an agent, I kind of pose this to you as like, okay, if you're an agent, what would you be thinking about? What kind of questions would you have?
I don't know. I think just sharing your screen like we're going to do is going to be helpful for the visual people like me.
Yeah. So we're going to do a little screen sharing and kind of talk about our method. And so we talked about the process and who qualifies and what's the good and bad with that, right? So how do you fund these, right? And most importantly, where do we find houses for sale with assumable loans, right?
Right.
Is it that easy? Or why can't you just find them on Zillow or Realtor.com or on the MLS? Is there a way you can find them on the MLS?
Yep.
Yeah, potentially you could. I think it may. If somebody could do a search depending on your MLS, right? I haven't done it. I don't have access to the MLS, but I haven't done it. But potentially somebody could, right?
Yeah.
But if somebody's doing that, I haven't seen it.
Yeah, it's just like with the tools that you and I use, you can drill down and see more accurately what their rate is, what their balance is, and figure out.
Yeah, so if you have access to the MLS and you're an agent, you could potentially do it. I think it's probably a little bit more of a manual process, right? So we have a easy button, as I call it, right? A little bit of a shortcut where we have we have a tool that kind of helps us in that process, right? So we're gonna dive deep into that. I'm gonna do a screen share with that, and let's see how this shows up on your end. All right, so let's see. We're doing this live, so any technical difficulties, don't blame me. It just is what it is. So let's see if we can do a share my screen here. All right. All right, so all right. Can you see that?
Yep.
So I have a couple of screens working here. So let's start here. All right. So this tool that we got here is basically a tool that shows all the properties in a particular market that have an assumable loan. So just as an example, right? Since we have James, who's in the Denver market, this tool will actually let you draw the area that you want to do. And circle that. See that?
Yep.
And on the right side, it's going to show all the properties in that area that are assumable. It also has a couple of different filters on here. So we already did the filter, but let's just say it'll let you filter by VA, FHA. So you can click all these and it'll give you all, right? But I'm going to take out USDA for a second. All right. And I want to work with FHA first. But before we get to doing that, it's like, okay, so what would be the difference, James? So we talked about this a little bit. What would be the difference if assuming a VA loan versus an FHA loan? And where's the challenge in that?
So with FHA, if somebody comes in as the borrower, that FHA seller can go and buy another home. With a VA, so it depends on who the buyer is. So if it's another VA buyer, that VA seller can take their eligibility. It's called eligibility. So they can take their whatever $500,000 and go buy another $500,000 house. But if that buyer is not a VA, they're just a regular non-military person or an investor, they can take over that loan, but that veteran can't take their eligibility and go get another property. It's locked up. That eligibility is locked up. So
so that's the challenge. Well, that's the challenge when you take over a VA loan, trying to get the seller that has a VA loan, right, is trying to negotiate for you to take over that VA loan without their VA entitlement being released. So it's an entitlement, right? Unless you're already a veteran. And if you're a veteran, then the new veteran buyer places their entitlement and releases the entitlement of the veteran seller. But if the buyer is not a veteran, then that entitlement remains attached to the loan, and that veteran, when they sell the house, their entitlement is attached, so they can't take it with them for their next house. Now, there are some qualifiers with that, right? So, I mean, some of you people that are a little bit more knowledgeable and understand this process, right? So there's an amount of entitlement but when they bought this house or when they used their entitlement for the loan that they have now on the house that they're trying to sell, let's say a used partial entitlement. So it's so it's not a 1-for-1, it's a total amount, right? So there's a calculator that I have access to where you can sort of calculate and say, hey, if I left my entitlement or a portion of my total entitlement, how much more entitlement do I still have left to buy a next one? So theoretically, there could be, if the price point is low enough, then theoretically somebody could have 2 VA loans and they leave one and then go get another VA loan or use a portion of their VA entitlement for the next one, right? So there's a calculator that I use to determine, hey, if we leave this much entitlement, because we're using, let's say, 60% of your entitlement you're leaving behind, but you still have 40, what does that equate to when you buy a new one, right? So let's just keep it simple. Let's say the entitlement's $1 million and you've used up $700,000 of entitlement on the one that you're leaving. That means you're still left with $300,000 of entitlement. Well, obviously, if you're going to go buy another $700,000 house, then you only have $300,000 worth of entitlement to be able to use. So you can't do 100% financing. You would have to come up with a difference.
Yep.
Right? That the entitlement is the insurance, basically saying VA says, hey, we will insure a portion of the loss if this person does not pay. That's really what it is, right? Entitlement is really insurance. The VA is guaranteeing the debt that's being done by the lender. So if somebody doesn't pay, then they pay a portion of that, right? It's typically 25% of the loss. That's really what it comes down to, right? And it works the same way as FHA, right? That's why on FHA you pay an upfront mortgage insurance premium, and then the monthly EMI is because that money goes into a pool, right? A pool of money that accumulates on all the loans that are done, and then from that pool, any defaults that money is used to pay defaults on FHA loans, right? So defaults meaning somebody doesn't pay and the lender doesn't recoup all the money that they lend out. So if they lend out 100,000 and they have to sell it at foreclosure and they can't sell it and they only recoup 80,000, well, that 20% loss is paid out of that fund.
Yeah.
So VA sort of works in that same method, right? So anyways, so that is the challenge if you're going to take over a VA loan, is being able to, one, get the selling agent to get their buyer to agree to leave the VA entitlement, or two, if you're a buyer and let's say you aren't working with an agent, look, how do you negotiate that, right? What's the conversation you're going to have with the seller, right? So obviously that takes a little bit of a higher skill set to get ahead and kind of work through that and have that discussion. And if you're doing it solo and you don't know, what to do, and they don't know what to do, then I guess, you need experts to kind of help you through this process, right? So that's why we're here, right? That's why James is here. That's why I am here. And then we have other agents and lenders that kind of understand this process, and we can direct you if you happen to be in a market where we're not in. But generally, we can work with anybody. It's just going to be about what your situation is and what potentially is out there as far as like available properties on the market, and helping you searching that and connecting you with the right individuals and kind of walk you through this process and coming up with a game plan for it. All right, so back to VA and FHA. So for this purpose, I'm going to exclude VAs, right? So if I exclude VAs, it'll just take out all the VA loans and only leave properties that are active that have an FHA loan. Just simplicity purposes. So that way we know on FHA loans, there is no entitlement that's being left. You don't have to kind of fight with the seller or hope that they take you up on it, right? Potentially you can just say, hey, Mr. Seller, if I can qualify for your mortgage and get the assumption done, I will pay your price, right? And then if the seller says, well, what about you're taking over it, right? So yes. So on an FHA loan, if somebody assumes the loan, then the liability to the seller is released, meaning they can go buy another FHA loan, right? Or they can use FHA again on another house, right? So that potential default issue isn't there. They're released when a new person qualifies and the servicer and their assumption department approves that person, say, yep. And then what ends up happening, that should come off their credit. And then that'll start reflecting on the new person's credit in case that they don't make the payments on time. Any questions about that, James?
I don't.
All right. So in this example, so here what do we got? We got 451 properties that are FHA assumable loans that are active in this market. So we're in Colorado, so we're using, since James is out there, I'm going to take an example of a few of these properties, right? So on this one is selling for $375, but has a 2.77 interest rate. Well, this one, 549, 2.83, right? So this is super juicy if you think about it. So we keep going, 2.64, 3.19, right? 3.06, 3.64, 2.85, 4.98. That's still better than market rates. Look at this, 2.73, 3.95, right? So this little tool here that we have helps kind of figure out, oh, well, now obviously rate shouldn't be the driver necessarily, right? I mean, if you don't like this neighborhood and it's away from where your job is, or you don't want to live in that area, or the house isn't big enough, whatever, then the rate really doesn't make a difference, right? So it's important to be able to kind of, hey, can we do this by zip code, right? So we can enter a zip code or city and then narrow it down to like, okay, all the properties in the zip code, these are the ones that are available and what the rates are, and then what's the price point, right? And going back to the example of coming up with the gap, right? So let's walk through this scenario here. So on this property here, yes, you're getting 2.77. They're selling it for $375. This is saying that you would have to come up with $139 down because their balance is $375 minus $139. That's the gap. That's the equity gap. Well, so what the problem there is, if you don't have this money, then you can't just take it over, right? Because the the servicer is going to let you assume the loan is going to say, okay, I see this purchase price is $375, but the balance on this loan is what is it, $249? No, 236. Right? My math right? Yep, 236. Right? So the remaining balance on the existing loan is 236, purchase price is 375. Do you have the 139 to take it over? Plus the closing costs, plus the servicer's document prep fee and whatever fees they may charge, right? And then you still have the title fee and so forth, right? Title, escrow, insurance, and setting up the escrow funds and so forth, right? So you have to come up with this difference. So it's not just, yay, I get a cheap rate, but what about the money? Like, so if people don't have this, the gap from the price to the balance, then it's going to be a problem, right? So look at this one. So you got to come up with 439 to take over this 3.91. And as we know, people's equities have gone up a lot over the last 5 years, right? So this is the challenge. Let's say people bought in the cheap rates were like 2020, right? We're in 2024. So how much equity went up, right? So people have a lot of equity in their houses, as you can see, right? When they were getting cheap rates, prices were going up. Well, they built up a lot of equity, and if you don't have that difference, so on this one is reasonable, right? 285. Somebody potentially could have that one, right? But most of these are 6 figures and higher. So this one, this one's not too bad. This one's 54. Okay, potentially you can work with that. This one's 58. Okay, potentially somebody can work with that, right? So anything less than 100, right? Potentially somebody can work with that, right? So 56 here, 220, right? So 77, all right. So now the question is, okay, so let's say my options are limited and there's very few that have a gap of, let's say that less than 100. How about less than 50 or 50 or below, right? Maybe I want to come up with 25 only, or I only have 25. How do I make up that difference? Okay, potentially from a lender's perspective, and then from the servicer, potentially you could get a gift. Yeah, so you can get a gift. So gifts are eligible. Gift from a family member are eligible, right? How about a loan? So I have a couple of options, a couple of lenders that will lend on that gap, but they won't lend 100% of the gap. They still want to see you put some skin in the game, right? They're not going to finance. So in this example, let's say the sales price is 375, the gap is 139. They're not going to come in with a loan for 139 for you and finance 100%, right? They're going to want skin in the game on your part, and typically, it's going to be 10% down, 10% of the purchase price. In some instances, they'll go as low as 5% if you have very good credit, right? So you're getting basically a second mortgage to come up and fill in that gap. So even at the 5%, but I want to keep it round numbers and keep it simple. So let's say you we're going to do the 10% lender. So you would have to come up with $37,500. And the lender would, so if you take 37.5 out of the 139, right? So that's talking about, that's 101,500, right? So they would lend the 101,500. You come up with the 37.5, and then you get to take over the balance of this one. So you're still going to need some skin in the game, right? So like I said, for simplicity purposes, 10%. If you have a very good credit, potentially you do 5% on it, right? So does that make sense, James?
That makes sense to me.
All right. So any questions that you can think of as an agent, and any challenges or things that, say, a client may ask you or you may have thought about?
Yeah, well, I work with a lot of investors like you do, and we're investors ourselves. So an investor can take over a VA loan. Of course, like we said before, that VA seller will not be able to walk away with their entitlement. But an investor cannot take over an FHA loan. So just keep that in mind.
Correct. So investors, you can't take over an FHA loan. You can
gotta be-
potentially take over a VA loan.
Yep.
Right. And one, you have to get the seller to agree to leave their entitlement unless you're a veteran. Two, you have to come up with the gap. Three, or borrow the gap, but it won't be 100%. You still need skin in the game. And depending on who the lender is that does the gap funding, right? So on an owner-occupant, if you don't know this, on an owner-occupant, lenders are a little bit more lenient than they are on an investor, right? So if you get an owner-occupied property conventional loan with 5% down because you're going to live in it, that's one thing. But if you're going to get an investment loan, conventional loan, you need 20% down. So the gap funders or the gap lenders in this instance may require more than the 5 or 10% that we're talking about for an owner occupied. So a primary residence, they may let the person come in, or they may lend the person that has maybe 10 or 5%. But if you're coming in as an investor, not likely they'll let you come in with only 5%, right? It's probably going to look more like 15 to 20. Which potentially could still make sense for you, but that means you're still going to need the money, right? So it won't be 100% financing. And that's the challenge. I see a lot of people talking about this. Oh, yeah, take over a VA loan and, you're an investor, blah, blah, blah. Sure, you can if you have the money, right? If you have the money. And you still have to qualify too, right? So you may be an investor that has bad credit, so you can't assume a VA loan.
Right.
Right? You'd be an investor that doesn't declare any income, right? Because you're, I don't know, maybe you're a new wholesaler, or hey, you do a lot of syndications and you're cost segregating and doing all this other stuff, right? And basically, you're declaring zero net taxes. So when it comes to qualifying for these kind of loans, they're looking at the traditional kind of qualifying guidelines. Yep. So that's the challenge with that, right? So it's easy to say, yeah, you can take it over. Sure, if you fit into the box, yes. And you have the money, yes, right? But how many investors fit into that? Probably not everyone, right? Or whatever that amount may be, right? So that's when it kind of starts to narrow down who's eligible and whatnot, right? So I know a lot of people pitch this, but
it's not
hitting. Yeah, I mean, it's just, hey, yeah, you can, right? But then once you start going down this path with it, it's like, oh, there's this and this and this and this. I don't fit into the box, even though somebody told me, yeah, I can just take it over.
Yeah, this is not like a lot of investors subject to where you're taking over somebody's loan subject to their existing financing. That's a whole different ballgame because
a whole different strategy there, right?
We're
talking about just assuming a loan with qualifying where the loan is in your name. And the sub 2, the loan is not in your name and it remains in the seller's name.
Yep. Yeah, we still are working with banks. Got to check all the boxes.
Yeah. But right, so I know we work with investors, but I want to set that aside because investors are like a unique niche.
Yeah.
And they're a smaller portion of the overall population. For us, they're a bigger portion because we consistently work with them. But generally for agents, for traditional agents or traditional lenders, well, let's just focus on agents, right? Agents that have clients that say don't qualify at today's rates, but if the rate was lower, they potentially their ratios, their DTI would actually fit in and they potentially would qualify. Now, the challenge with that is, let's say somebody's a buyer today, let's say at 6.5% on an FHA loan, and they only have 3.5% down. Well, they're not going to be able to assume a loan that has a big gap in equity, right? Or a gap of greater than that 3.5. Right. They're going to need at least 5% to potentially work with one of our lenders that will do the gap, right? So as a lender, I have a couple of options on that, right? So they're going to need at least 5%. So if you're an agent, your buyers only have the 3.5%. Potentially, could they get the gift for the additional 1.5 from a family member? Yeah, I mean, you're close enough, right? And if they have good credit and you have verifiable income, then, and you can qualify traditionally like you would on an FHA loan, then potentially, yeah, right? But if they don't have right, this doesn't work with somebody that needs down payment assistance.
Right.
Right. So this works with people that have some money, and have credit and verifiable income, but potentially you're getting a deal at, even at 3.95, right? That's a pretty good interest rate to take over, right? Compared to like say 6.5 to 6.65, 6.625 on FHA today, or 7% on a conventional loan, right?
Mm-hmm.
So
I'm glad you brought that up about who fits the box versus who doesn't, like the down payment assistance people. It actually kind of lines up with a lot of the people we work with through our rent to own programs, self-employed buyers that do have good income, that do have good credit and some money put aside. But the banks are kind of holding off for some reason, but they might fit into this box still. So, I mean, if they don't fit in this box, then we can help them with rent to own, I guess is how I should pose that.
Yeah.
Right?
So for us, we walk people down this path. And if the path is doing something traditional and they qualify, then great. Then you just go get a loan. Just get a traditional loan, and that's that. And then, wonderful. But if you're an agent or a buyer that needs a plan B and a plan C and a plan D, we're the people to talk to, right? We're the ones that kind of have all these solutions, right? We're the ones that kind of can get creative, right? This isn't stuff that your brokers are teaching, right? They're not taking the time to kind of figure this out and kind of, oh, well, it's too hard. Now, another challenge that comes up on assumable loans, people, there's a notion depending on the servicer. So the servicers kind of walk at their own pace, right? They kind of they tend to be a little bit more reluctant to do this and maybe a little bit more nitpicky because, hey, if you're going to a social lender, and would they rather have you get a new loan at 6.5 or let you take over a loan at 2.73? Which one do you think they want? Right?
Yeah.
So they're gonna slow walk it a little bit, right? That's generally been the kind of the history in the industry. And people is like, well, it takes too long, or sometimes, right? Sometimes I've heard of horror stories, that, it takes up to 90 days.
Yeah.
Now we're set up with a process and a service provider that'll help expedite that, right? Because they're tied into all the servicers and know all their criteria, and they know how they work to try to get this moved along. So typically it's going to be like 40 to 45 days, right? Instead of the 60 to 90 days that a lot of people, if you go do it on your own, right? Now, technically, somebody could just go do this on their own. Find out what the servicer's number is from the sellers, from their banks, from their mortgage statement. Call them up and try to find the department that handles this. And maybe you get switched to this department and that department until you find the right person. Then they say, oh, no, never mind, you don't qualify, or go away, or whatever that may be, right? So there's a challenge of you doing this on your own, right? So the service provider that we have charges a couple $1,000s to do it. They're tied in. They know the process. They know what are the criteria, who works fast, who works slow, how to push the right buttons, who to call up on that chain to get things moving, and so forth, right? So again, we have access to that. So if you're interested in working with us, reach out. So so that's another part, James, that I forgot to bring up, but is generally the perception that, hey, yes, I can go through all that stuff, and at the end, it's just going to take longer. Well, yeah, but not as long as you would think, if you're working with the right people. And two, is it worth the extra 10 to 15 days? Now, maybe the challenge is getting the seller to wait an additional 10 to 15 days. But agents, come on, you could just write that offer and say, hey, the offer is full asking price, or maybe even over asking price. How about that?
Right. You're getting a good rate. You could pay more.
A good rate. You're saving, let's say you're saving $100,000 on the rate over the life of the loan. Are you willing to pay an additional 10% or 10,000 or 15,000 over asking price to get the seller to agree to wait an additional 10 to 15 days and take over their loan? Right? So there's a balance there. So for you agents that have listing that your clients have potentially an assumable loan, then that's a way to sell it to your clients as a listing. Say, hey, look, this property's been on the market for 60 days or 90 days already, right? So days on the market are a little bit longer. What if we add this option and we can potentially draw more buyers and maybe even get you a little bit more money than what we're asking for?
Yep.
Right? If we put that option out there, are you open to either selling it on an assumption? If it's an FHA loan, there's nothing happens to you. You're releasing the liability. On a VA loan is having that second conversation, like we talked about earlier, about the entitlement, non-entitlement, and potentially have your seller agree to something like that, and you come in knowing and explain to us, hey, if we're gonna get an assumption buyer, probably gonna take an additional, let's just say round it up 15 days to get it closed because it just takes a little bit longer, but that's okay. You're getting paid to wait, right? Meaning they're gonna, we're gonna negotiate a better price, or they're gonna come in with a higher than asking price offer, potentially to give them that additional time to get it done, because they're saving on the rate and the amount of money that they pay over the life of the loan, but they're willing to kind of pay up on the a little bit more on the price, and that's where you benefit as a seller.
Yep. That should be one of the first questions when you're in a listing appointment. What kind of loan do you have? Because that could be gold.
Yeah. So there's your there's a $1 million tip right there, right? $1 million tip right there. That should make you a couple of extra deals.
Yep.
People that aren't doing this or don't understand this, or aren't working with the right individuals like us, they're missing out on a potential opportunity. So, anything else you want to add to? Right. So, from an agent's perspective, anything you want to add?
Nothing's coming up top of mind that we haven't talked about. So
yeah. So you think we've covered any potential pitfalls and questions that are kind of tied into this process, right? So we covered what are they, who qualifies, how do we find them, what about the equity gap, which is a big issue, what's the process, right? Is there potentially a longer timeline? So we address all of these. So this is a different solution for a market that needs a solution.
Yep. Yeah, I think we covered it. If anybody has questions, they can reach out.
Yep. And you'd like to get talk to us about our handy tool or work with us, let us know. So I think that covers it for today on this chat. I think we covered a lot of info, a lot of good info. I think this training by itself is worth at least $1,000.
Heck yeah.
Yeah. All right. If people want to get a hold of you, James, how can they do that?
Go to Linktree/partner with James Brown. It's right in my little title there. If you're watching, there we go. That's easier to read.
Yeah. Cool. And if you want to get a hold of me, you can go to my socials or our website. Website is www.rent2ownhomesus.com, or you can follow me on social media. I am at Mr. Rent to Own Homes on TikTok. It's still alive. YouTube, Instagram, and that's it. And you can find me on Facebook. I am Dominic Danino, aka Mr. Rent to Own Homes. Reach out. We can have a conversation how we can implement this in your business, how we can work together, how I can provide a lending solution for you on these gaps of equity for your clients. And then how do we work through this process? So let us know. Looking forward to hearing from some of you. I know some of you are going to be shocked by the fact that this is possible, and your brains are going to explode, and you're going to start thinking, oh, what can I do with this? How can I market this? How am I going to make myself different than the rest of the competition that's chasing their tail, trying to generate business, right? So yeah, Here's an opportunity for you, but you got to work with the right people. Anyways, that's it for today. Thank you all for joining us. Bye-bye.